Hi everyone, my name is Shane. I'm head of marketing at Kyber Network. Today I'm going to be sharing with you a little bit more about our upcoming plans for Kyber, as well as our latest protocol called Kyber Dynamic Market Maker, or Kyber DMM for short. And I'd like to thank EDCON and their team for inviting Kyber to participate in this virtual conference and inviting us to share about our project. So for those of you who are not familiar with Kyber Network, we started back in 2017, and previously we were an on-chain liquidity protocol, but with our recent Kyber 3.0 upgrade, we are now a hub of different liquidity protocols catering to different DeFi use cases. So our aim is, having in mind that in DeFi, there are many different target audiences, there are many different users that require liquidity for different needs. We are trying to cater to these different needs by developing different protocols to suit these needs. And the recent major protocol that we came up with is called the Kyber DMM. And this caters to a general target audience of any liquidity provider that wants to maximize their capital in DeFi. So one of the some of the key problems that we observed in the DeFi space today is among the most popular type of liquidity provisioning platform, AMMs, or automated market makers, is that first, they can be extremely capital efficient. If we are talking about the most common constant product formula type of AMMs, they are very capital efficient, and this is more pertinent, especially pertinent for stable coins. For this type of AMMs, you can see that because they cover an infinite price range of 0 to infinity, although this is great, for long tail assets and helping them cover a big price range due to their volatility, for assets where you are more, you can expect a certain range, upper and lower bound for the range. A lot of the inventory that you deposit into the pools are actually not used. And so this makes them very capital efficient. So you need an exorbitant amount of TVL or assets deposited into the pool in order to achieve decent liquidity. Second problem that we see that AMMs face as well is that, of course, of impermanent loss. And there's a lot of literature around this. This has been covered over the past year a lot of times. I'm not going to go into detail, but in general, a simple scenario for impermanent loss in a typical AMM is that there will be opportunity cost for holding two assets, right, in the pool when you are a liquidity provider. In this simple example, if you're holding like KNC and ETH as a liquidity provider in the pool, when the KNC price goes up by a large amount, you might have the opportunity cost of, instead of holding KNC alone, 100% in KNC, you're doing it 50-50 for KNC ETH, and you actually, could have made more by just holding KNC. So this is, of course, a very simple example. But in general, whenever there's price fluctuations for a pool where you're holding two assets, you might suffer potential impermanent loss. And third, with the proliferation of so many AMMs out there, and of course there are established reputable projects and AMMs that have been in space for a very long time, and these are the ones that you can trust, right, more. But there are also a lot of new AMMs coming up that are basically forks of the more established and reputable ones, those that have already gone through multiple rounds of audits. These forks might have added more features, and this increases the complexity of their AMMs, and that also increases the risk of vulnerabilities and bugs. And we have seen so many hacks even this past year. So a lot of the typical AMMs you see today might have poor security as well. So keeping these problems in mind, Kyber Network, for our latest liquidity protocol, we aim to try to tackle these problems. And this protocol is called the Kyber Dynamic Market Maker, or DMM for short. And this is DeFi's first multi-chain dynamic market maker. So up till today, most of these market makers are the typical automated market makers you're seeing. For Kyber, how we are trying to, our approach, right, to really give more benefits to DeFi space in terms of liquidity is to provide a more flexible and dynamic type of market maker. And we position this as a next generation AMM that helps liquidity providers maximize the use of their capital by enabling extremely high capital efficiency through our amplified liquidity pools and optimize returns for liquidity providers through dynamic fees. And I'll go deeper into the details in the next few slides. So for capital efficiency, how do we actually tackle this? For typical AMMs, as I described earlier, the constant product formula usually caters to a 0 to infinity price range. But what we are doing for the Kyber DMM is concentrating the price range with a lower and upper bound by allowing liquidity providers to add an amplification factor to it. So if you if you input an AMP of, let's say, 1.3, you can enjoy 1.3 times the 30% better capital efficiency. And this can be done very easily within 5 minutes when you create the pool. So for most pairs, what we recommend is 1.15, 1.3. It differs. For less volatile pairs like WBTC and ETH, of course, it can be quite volatile as well, but relatively to some new coins, a less volatile pair like WBTC and ETH, it can be 5 to 10 times more capital efficient. And this benefit is very clearly observed for stable pairs like USDC, USDT, where you can go up to even 400 times more capital efficient and with better slippage. So in general, with the Kyber DMM's amplification factors, liquidity providers can create amplified pools, and the future liquidity providers, when the pool is already created, they can add more liquidity to these amplified pools to also enjoy the high capital efficiency. And with a fraction of the TVL compared to a typical AMM, the liquidity on the Kyber DMM can be much better, the slippage can be much lower, and the volume generated can be. So this is a very basic example. For a USDT/USDC with a TVL of $110 million, and with a lower TVL compared to typical AMM without any capital efficiency, we are able to provide better rates. Of course, this also depends on the token pair, the token amount, the trade size, and at any given point in time. But just to illustrate how what I mean by amplified liquidity is having a fraction of the TVL compared to another AMM and achieving the same or even better rates for the pair. So the second key feature for the Kyber DMM is that it has dynamic fees. So unlike the static nature of typical AMMs where there are fixed fee tiers, no matter how volatile the market is, for the Kyber DMM, when the market is more volatile, when there's a lot of demand for the tokens, fees actually increase to capture more value for liquidity providers. But when the market is less volatile and you see trading volume start to decrease, the fees will automatically become less so that it encourages more trading, and overall the collected fees will be higher as well. And so this offers greater flexibility compared to typical AMMs and optimized returns for liquidity providers. And in the process, it helps to mitigate and reduce the impact of impermanent loss. So Kyber DMM is fully permissionless and open source. Anybody can integrate with it. Any DApp can integrate with it. Any liquidity provider can create a pool, can add liquidity to existing pools, and any takers like DEX aggregators or any new AMMs that wants to actually source liquidity from multiple platforms, they can integrate Kyber DMM. Our objective is really to provide as good liquidity as possible for the DeFi space. And we are very open to help any project that is willing to get very good amplified liquidity for whatever dApp that they're building, be it a game, a lending protocol, and you need a liquidity for liquidation. If you are a DEX aggregator getting the best rates, you must integrate the Kyber DMM for sure. And one of the points where we try to mitigate risk is also not to have an external oracle for this protocol per se. And as I mentioned earlier, in the DeFi space, there are a lot of hacks happening. And one of the main reasons is because some of these developers, they are just forking the code from more reliable protocols and adding some features, increasing complexity, but without auditing, without ensuring the protocol. So Kyber DMM, we have a very strong commitment towards security and reliability. We have been audited by Chain Security. It's a very well-known audit firm that was acquired by PwC. We are open source. You can look at our code on GitHub. So we welcome community developers to also fact check and verify our code. And we have an ongoing bug bounty. So reach out to us. If you're a white hat, if you discover anything, we'd love to help and see how we can, compensate you for your efforts. And unlike a lot of protocols, we are also insured. And we are working with Unslash Finance, and Kyber DMM is insured up to $20 million. And we are also looking to increase the insurance as our TVL goes up. So who can use the Kyber DMM? Basically, anybody in the DeFi space, right? It covers a broad range of use cases and target audiences. So dApps and wallets that want an easy way for people to swap tokens, or just as another liquidity source, they can integrate the Kyber DMM. For example, a very popular wallet in recent times, Coin98, has already integrated Kyber DMM. DEX aggregators like 1inch, 0x API, Matcha, and other popular aggregators have also integrated the Kyber DMM. For decentralized financial products, let's say if you are a lending protocol and need a backend liquidation mechanism and you require a liquidity protocol to liquidate your assets, Kyber DMM could be an option for you as well. Asset management platforms that want to give a variety of options for their users to trade tokens, they should ideally integrate the Kyber DMM as well. And of course, token teams that are looking to provide very good liquidity for their tokens when they just do their IDO. And with Kyber DMM, as I explained earlier, with just a small pool, you are able to give your users and traders very good rates for your tokens. So just to illustrate how easy it is to create a new pool, you basically need to just type in the ratio of the tokens you want to add into the pool. If you are the first pool creator, set your AMP. So this stands for the amplification factor. A higher AMP is ideal for more stable pairs, but for new tokens, a lower AMP like 1.15 to 1.3 is recommended. And based on the AMP, your active price range, your upper and lower bound for the tradable range for the token pair, and your dynamic fees will also change depending on the AMP. Once the pool is created, adding liquidity is also a piece of cake, less than 5 minutes. Just key in the amount of tokens that you wish to add into the pool. The required ratio for the pool will change over time depending on the trades that happen through the pool, but it's indicated there on the UI. And after adding liquidity, you get DMM LP tokens that represent the share of your pool. So whenever you return your LP tokens to get back your initial liquidity, all the fees that have accumulated for you being an LP will also be withdrawn automatically when you burn your LP tokens. For those of you who are interested in trying out the Kyber DMM, we have an ongoing liquidity mining program called Rainmaker. So we recently partnered with Polygon, but the Polygon phase of the liquidity mining program, the first phase is ending soon, I think a couple of days, if I'm not wrong. We are looking to continue that soon. But for the Ethereum part of the liquidity mining is still ongoing, so feel free to try it out. You are going to get decent returns for being a liquidity provider for selected pools. So right now, for the Kyber DMM alone, we have already surpassed $1.1 billion worth of total trading volume. So Kyber, just as a recap, Kyber DMM is just one protocol in the entire Kyber network's hub of liquidity protocols. So for the whole Kyber network, we actually have surpassed $6 billion worth of trading volume. On Kyber DMM, we now have about $440 million in TVL, and considering that we are still in beta, this is we are very happy with the current TVL, and this is on Ethereum and Polygon. So for total amplified liquidity, so this is liquidity that is, when you compare it to a typical AMM, how much liquidity effective or what we call amplified liquidity there actually is. So it's about $36 billion. So how we get this number is for all the pools that have amplified liquidity, we multiply the amp factor with the TVL in that pool and sum all of them up. So if you integrate with the Kyber DMM, and if you add liquidity to Kyber DMM and be part of the Kyber network ecosystem, you also gain access and exposure to all the 100 over dApps that are already using Kyber network. So what's next for Kyber and Kyber DMM? So right now, Kyber DMM is on Ethereum, Polygon, and will soon be on Binance Smart Chain. As our Kyber DMM protocol is meant to be multi-chain, we are already looking at other networks and chains out there like Avalanche, Polkadot, Solana, and any popular chain that the community would like us to research and look into. We'll be happy to explore further. So for Kyber, we are a very community-driven project, and we always welcome feedback from the community. I think at the end of the day, the community is what really drives the success of any project. So for the next, in the short term, we are looking at expanding into multiple chains, improving the Kyber DMM and optimizing it further, making sure that it provides very good liquidity for the DEX aggregators out there, for the dApps out there, and the wallets out there. We are also looking at layer 2, specifically roll-up solutions. And apart from just deploying into multiple chains, we are also researching swaps between chains. So on both fronts, swaps within the chain and swap between the chains, and scaling the whole process through possible layer 2 solutions. These are some of the initiatives that we are looking at. So to recap, Kyber DMM is DeFi's first multi-chain dynamic market maker. We aim to maximize the use of capital for liquidity providers and for traders by enabling very high capital efficiency through our amplified liquidity pools. And we also have dynamic fees, right, that optimize returns for liquidity providers by changing according to the market conditions. So this brings me to the end of the presentation. I really thank you guys for listening in, and thank you, EDCON, for inviting us to talk about Kyber DMM today. Just to remind you, Loy, our founder, is having another call in about half an hour at 11 p.m. GMT, and he will be on the panel for layer 2 solutions with Chain News, Metis, Starkware, and Few Labs. So be sure to tune in for his panel talk as well if you want to learn more about the Kyber's